Find out why diversifying your portfolio makes sense and how to maintain it. There are two moments when checking on your investments may be irresistible: during a bull market when it's roaring ahead, or during a bear market when the market is correcting. But that's when emotions have a nasty way of clouding the judgment of even seasoned investors. We believe that setting and maintaining your asset allocation targets are among the most important ingredients in your long-term investing success. Take the emotion out of investing and build an investment strategy that suits your risk profile. We can help you with that. The goal of diversification is not to boost performance or insure against losses, but it can help set the appropriate level of risk for an investor's time horizon, financial goals, and tolerance for portfolio volatility, ultimately giving the investor peace of mind. At the heart of diversification lies correlation. Simply put, correlation is a measure of how the returns of two investments move together. For example, when the returns move in the same direction or opposite directions, and how often. When you put two assets that have low correlation together in a portfolio, you may be able to get more return while taking on the same level of risk, or the same returns with less risk. The less correlated the assets are in your portfolio, the more efficient the trade-off between risk and return. You need to make sure your investment mix of stocks, bonds, and short-term investments is aligned to your investment timeframe, financial needs, and comfort with volatility. These sample target asset mixes show some asset allocation strategies that blend stock, bond, and short-term investments to achieve different levels of risk and return potential. When building your portfolio, consider the return and volatility trade-offs. Within your portfolio, beware of an overconcentration in a single stock. You may not want to hold more than, say, 5% in any given security. In other words, don't put all your eggs in one basket. A well-diversified portfolio will hold between 50 and 200 securities. We also believe it's smart to diversify across stocks by capitalization, sectors, and geography. Not all caps, sectors, and regions prosper at the same time, so you may be able to reduce portfolio risk by spreading your assets out. When using investment funds, you should also consider using a mix of mandates such as value, growth, or a blended strategy. If you need to increase your bond allocation, consider bonds with varying maturities, styles, sensitivity to inflation, and interest rates. There are many types of fixed income investments that all have different objectives. Not all bonds are created equal. If you're using investment funds such as mutual funds or segregated funds, you will want to consider whether they've been strong, consistent performers relative to their stated objectives and styles. Predicting how inflation interest rates will move is very difficult. So proper fixed income selection is one of the most important things your advisor should focus on. Diversifying alone is not enough. Once you have a target mix, keep it on track with periodic checkups and rebalancing. If you don't rebalance, a good run in stocks could leave your portfolio with a risk level that is inconsistent with your goals or strategy. Let's take a look at how different a portfolio can look over time if you fail to rebalance regularly. From April 1993 to April 2013, virtually every asset class changed their portfolio weighting. If we fail to regularly review and rebalance our portfolio, the intended risk profile will almost certainly fall out of check. We suggest you use an investment professional to help you design, build, and monitor your portfolio strategy. Be sure to interview many advisors before choosing one. Check their references. Ask them to share their investment philosophy with you. Just remember, they're choosing you as much as you are choosing them, so there has to be a good fit. As a guideline, you may want to consider rebalancing if your stock allocation moves away from your target by more than 5 to 10 percentage points. If you don't invest the time to be involved in your portfolio, you can't be disappointed with the results you achieve.